Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Hi, everybody. I'm Jeff Barton. Welcome to The Mortgage Voice. Thanks very much for tuning in. The show itself is on 5 different radio stations in 3 different states. We've just added Albuquerque, and we're still trying to find a resident Albuquerque real estate agent to help us out in describing and letting other people know exactly what's going on there in the real estate market. It's changing everywhere, but each market, as anybody in real estate can tell you, does change and is different. It's like a microclimate would be in any area that you live in. One end of town is different than the other end of town, and it's certainly like that in the real estate world. And for those people in Albuquerque, welcome to the show. I know we're new to the area, but in fact, we can help you get loans, and we can help you decipher some of the problems that you may have when you're trying to figure out products, when you're trying to figure out who to trust, and the process involved. Today's show, we're going to have several people on who will talk about exactly that, whether it's rates from a certain lender, or whether it's processed by somebody who does this for a living on a daily basis, or we're going to talk about one of the main components when you're looking for real estate, obviously, is schools, right? Everybody wants to know where the best schools are and get into the school of their choice. But other things that are important as well, depending on who you are and your particular needs for that particular property, is healthcare services. And we've had on the show previously a paramedic up in the Ventura County area of California, and talk about services, how those affect what decisions you might be able to make when you're deciding if you have an elderly person in your family who needs that kind of service, or if you have a special needs person, or if you're just worried how close and how fast someone can get to you if in fact you have a problem or you do get into a situation where you need those services. Anyway, Jeremiah is going to join us today and talk about that. Certainly today with Corona, to talk about the emergency services and how they're being handled in that particular area. It's important. People have to know and feel confident when they pick up the phone and dial 911 that they're going to get people who not only can help them, but who will not infect them, who will do the things necessary to protect both parties in a situation which calls for either a trauma or a medical emergency to be taken to the hospital. And so we're going to talk to him about that. And again, welcome to the show. You can see this show as well on YouTube. If you go to YouTube, Jeff Barton, The Mortgage Voice, that's who I am, and that's who the actual show title is on YouTube. We're on 8 major podcasts, Google, Apple, iHeartRadio, Spreaker, a number of other ones. Daryl, you have the major list, or at least most of it.
Yeah, it would be on Spreaker and Apple Play and, of course, radio.com and
Yep.
YouTube you talked about quite adequately.
Okay, excellent. Thank you very much. All right, so what is happening today in the mortgage world? Now, we've seen and we've talked about it, and I'm going to say on this show, 5 years running, we've been talking about low rates. And we've been talking about how those low rates are going to end. And it almost did end about a year and a half ago. And then we got into a situation where they were reversed. And we see debt in mortgages almost a year ago. Well, since COVID and since the Fed has stepped in and helped with their particular, fixes that they've come up with. It's hard to really, when you're a layperson and you're talking about the Federal Reserve and what they're doing for you, i.e., how is the Fed helping me get my mortgage? It's described because they deal in such large macro issues, like, for instance, buying mortgage debt, meaning they're buying the mortgage bonds, right? So you're not mortgage bonds, corporate debt. That's what I'm trying to say. So this was their latest fix, to go in and buy corporate debt, meaning they'll buy the corporate issues. How is that something that you will understand benefiting you as the mortgage guy? Somebody wants to get a 30-year fixed rate mortgage at the lowest rate. Why does corporate debt being purchased help you? And so in order to deal with that, finding a common language that we can share on a radio show on AM and FM radio on a Saturday and Sunday morning. So how does it help you? How does the Fed, in their general nature and what they do and what they've been doing in terms of propping the economy up? We've certainly seen stimulus from Congress, signed bills by the president, checks mailed out to those, unemployment benefits, $600 extra, which, by the way, is ending in July. But how exactly is the Fed and the Fed of what they're doing? We've had 2 or 3 days of testimony before the Congress from Jerome Powell, the head of the Fed, and he talked about buying corporate debt and what that means. Now, for us, what that means is companies will be able to continue to issue jobs, paychecks to people who are working. That's an important thing. And if you're out there right now and you're wondering, you're one of these 35 to 40 million people who don't have a job, if you're going to have a job come, July, come September, I'm not sure. I know that there are a few, if not many, economists saying that we've lost permanently about a third of those jobs. A lot of them will come back. Now, we've seen some retail job numbers, and we've seen some retail sales numbers, come out recently that suggest that the American public is ready, willing, and able to get out there and start spending. But it's a snowball effect. If I don't have a job and I can't spend money, then you can't hire somebody to service me spending the money of the job of the money that I don't get on a weekly basis anymore. And all of these things are dependent upon one another. So the corporate debt buying is about keeping jobs, about making sure that the dividends paid on those corporate dividends, when you're buying stock from them, keep going. It's about making sure that corporate America, people in the economy having jobs to be able to continue to support the economy continues, because we're just not quite sure when this is going to end. We do know that we have some good news on the medical front. We do know that some treatments are helping. We do know that a couple of treatments that came out last week in terms of the research they've been doing really affects people who are extremely sick and really cuts people who are going to die by about a third. Very important information, and these incremental steps along the way do help confidence and do help things going forward. I wish we had a more confident approach towards both the economy and COVID, rather than a piecemeal state by state, hey, you're on your own. I wish that we had more transparency in the amount of people that we've helped with the Paycheck Protection Program, but we don't. So we're not quite sure who got the money. We're not quite sure what the money is used for, but the company that I worked for, Malibu Funding, did get Paycheck Protection. It was about $30,000. Doesn't sound like a lot, but it really helped in the time to keep people in their jobs. The question of how that money will be repaid, or if it will be repaid, came out in a document about 10 pages long, very confusing, in order to prove that you use that money for the purposes that you can then get forgiven for. Now, I'm not sure whether that's by design, but it was a lot easier getting the money than providing the information to make sure that you don't have to repay the money. And that is one of the issues about transparency that we're trying to deal with now. Anyway, I'm Jeff Barton. It's a big show coming up, and we'll see you in just a few minutes.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks very much for listening to the show. If you want to hear the show, you can go to any of the major 8 podcasts, which we are on, from Google to Apple to iHeart to, Spreaker to, I don't know, there's just a million of them out there. But the big 8 are the ones we're on, and thanks to KCAA, one of our radio affiliates out in the Inland Empire in Southern California. We're in Albuquerque, New Mexico, as well as Las Vegas, Nevada, and up in Tahoe and KMET as well in the Inland Empire. Thanks very much for listening to the show. You can also hear us on YouTube. Go to YouTube, Jeff Barton, The Mortgage Voice. That's our YouTube channel. And we do a LinkedIn as well as a Facebook Mortgage Minute on a daily basis. Sometimes it's same old, but we've had a lot of different aspects to the mortgage market happening. And this week we've had Jerome Powell testifying before Congress about what the Fed's been doing. I'm going to shift gears a little bit. As I talked about earlier in the segment, a lot of times when you're going to look at properties and you're looking for a specific property location, sometimes it has to do with your proximity to other than schools, whether you're close to emergency services, hospitals, and things like that. One of the guys that's been on the show before, Jeremiah Bush, joins us. He's a paramedic up in the Ventura County area of Southern California. Jeremiah, how are you?
I'm good, Jeff. How are you? Thanks for having me back.
Oh, and thanks very much for coming on. One of the reasons I wanted you back is because the update for what's happening and the prolonged, I guess, exposure is a bad word, but the prolonged time that we've been dealing with this, how is it affecting you, your colleagues, and the people in the medical field?
Well, I can't speak for exactly my colleagues or other people around the country. I know for me personally, being a medical worker and an essential worker, not a lot has particularly changed. While a lot of people were told to stay home and isolate, I was sort of given the orders to do the opposite. I have to continue to go back to work and continue to be out in the public and everything else. So other than sort of society being shut down, differences in the ability to shop or go to restaurants, I still worked the same days as I normally would, and some differences in how we would approach patient care with certain, PPE precautions and screening questions and additional tests being performed in the field. But all in all, in spite of a pandemic, emergencies still happen. People still get in car accidents. People still have heart attacks. The system kind of has to go on. Interestingly enough, for a long time, and I think this was reflected in a lot of other places around the country, with the exception of some of your really hard-hit hotspots with the virus, is that for quite a while, 911 call volume had decreased and hospital censuses had been low. A lot of people, to be cautious with the virus, were not exactly seeking medical help. So there weren't as many people going to the hospital for mild to moderate type of problems, which in some ways has a good effect, right? It takes a little bit of a workload off of the hospital system that may have already been stressed out. But on the negative side of things, people weren't seeking health care for things that maybe they would have just a week or a month prior, and there's consequences with that too. But currently, it does seem to be kind of rolling back into its normal call volume and hospital census as far as patients being admitted and seen in the ER. But I don't think we're over anything just yet. This is just this month, right? Nothing's necessarily going away. We're just learning more about things and going about business with that most current information, which is always changing and evolving from week to week or day to day, as it seems.
Yeah, when you go out on a call, on a typical call, without the coronavirus, this was a standard of care that you were used to, and a lot of these patients that you brought to the hospital had tremendous confidence in the system to be able to help them, right? That was how it was working. In this situation where some of your patients, as you're saying, are not that anxious to go to the hospital or even call 911, how are you dealing with those issues? Are you having to do more on-site care than you normally would have, or are you just not getting the call volume?
Well, it was a combination of both. We weren't getting as much of the call volume as we used to, and then the motivations of patients had changed some. So there was a prior expectation of, after calling 911, a series of things would happen, and it would sort of end with a hospital transport. And now you're seeing more patients asking about their options. Do I have to go to the hospital? Can I just call my doctor on Monday? Should I go to urgent care? Should I go to the ER? And we've had to have those conversations with people and do what would be considered more primary care, or in parts of the country they call it community paramedicine or mobile integrated healthcare, to really sort of triage people's conditions and say, okay, well, maybe you can just wait this out, and maybe you can just call your doctor, because certainly for certain members of the population, by age or by pre-existing health conditions, for fairly minor issues, they may actually be putting themselves at a greater risk to go into the hospital than to stay home and have a telemedicine consult with their primary doc in a day or two, or kind of monitor their own symptoms. So patients themselves have been kind of starting that conversation of asking what are their other options and what they can do for those who do actually call. And we always try to give them, as many options as they have. Certainly when you call 911, you don't have any obligation to go to the hospital. Every patient has the right to refuse service, right? You're in control of your own body. But, people have been asking that question more now than they had in the past.
Yeah, I just think that patient care and how people get, we've had occasion at my house. I had 3 kids, and, once in a while, once every 2 or 3 years, one of them would have to get an ambulance ride to the hospital. We never really talked about what are the options. And I know people buying and selling real estate now, this is one of the aspects that they talk about. Okay, how far away are we from the hospital? How quick is the ambulance time here? How many questions do you currently get? And do you think that there's a change in healthcare, a sea change coming with more, as you were talking about other parts of the country, maybe paramedics doing some of this work in home rather than taking them to the hospital?
Yeah, I mean, a lot of these changes have been in the works for a number of years. Quite a few states have a pretty robust community paramedic program. North Carolina, Wake County in particular, as well as Vail, Colorado, some areas in Texas. They have a good community paramedic system where they work closely with the hospitals. They do a little bit more primary care in the field, and they sort of work as an intermediate partner between patients out in the world and facilities. And California did have a pretty large pilot study over the last few years, where we did some of those practices in terms of hospice care and post-surgical follow-ups and things like that. And it's, politics as they are and legislation as it is, we just haven't been able to get literally the language changed within the health and safety laws at the state level that would sort of allow paramedics to practice more on that advanced level. But there are a lot of people working at getting those things changed to have those things in California. But it really comes down to what's best for all entities, right? So you have to deal with a lot of organizations, Medi-Cal and Medicare and companies and healthcare systems and nurses unions and board of medical directors, and everybody needs to feel like this is moving in the right direction for all parties involved. And sometimes that is a slow and arduous process. But I think just with the virus in general, as we've been seeing people working from home more often when they can, the increase in telemedicine, appointments with the doctor, this may become more of a norm, pandemic or not. Realize there are cost savings in not having as large of corporate buildings to house employees, commuter savings, being able to see more patients more efficiently. Sometimes it takes a little bit of a shakeup to realize what you're actually capable of, when before you just kind of have the old system that works.
Hey, Jeremiah, thanks very much for coming on the show once again. I know you're a really busy guy, and I know we're taking you away from your day off, so I appreciate you coming on the show.
Yeah, Jeff, my pleasure. Anytime.
Okay, thank you very much. And it looks like the class is doing pretty well, too. I'm getting some texts from everybody that they're doing okay.
Okay, good. I'm glad to hear it.
Yeah, exactly. Thank you very much. And that's Jeremiah Bush. He is a paramedic up in the Ventura County area. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, and thanks very much for hanging with us during this difficult time. Corona is really taking its toll on many industries, even though we have seen some businesses come back. Let's see, where can you see us? Well, you can see us on YouTube. If you go to YouTube, Jeff Barton, the Mortgage Voice, that's our YouTube channel. We're on 5 different podcasts. They are 8 different podcasts, the big 8 they call them. And we're also on 5 radio stations. That's what it is. We're in 3 different states. Our new affiliate is down in Albuquerque. We're certainly out in Las Vegas and in the Inland Empire in Southern California, as well as up in Tahoe. We bring to you information about the real estate and mortgage industries, how to get a loan, what we're looking for to get you that loan, and some of the issues and problems we're facing right now with ability to repay, which is the big problem for a lot of people, especially if you've lost a job right now, but you want to refi that house, or you're looking to buy a house and you're not quite sure of your income, your employment. With us to kind of sort through the mess is loan officer and terrific processor, person who has done loans in many different states, been on the show several times, Jennifer Conrad, working for Malibu Funding. Jennifer, how are you?
I am great. Thank you for having me, Jeff.
Thank you very much for coming on the show. Okay, give us the 411 of processing a loan right now. What is the main component that you're looking for from a borrower?
The biggest thing is the lenders are trying to make sure that you are still employed.
Right.
It's okay if you're not in the office right now working. If it's a situation where we know you're going to go back to work, that's the biggest thing that the lenders are looking for, is to make sure that you still have a job. So we want to be able to verify the job placement at least. A lot of the lenders are tightening on their guidelines on credit scores. So we are seeing, 640. There are a few lenders out there still doing like a 600 credit score on FHAs, but they tend to ask for a little bit more. But the rates are really good. So, hopefully there's a lot of people that would actually want to take advantage of this opportunity to be able to refinance or do their purchase.
Well, it's a catch-22, right? I mean, you need more stringent qualifications to get the low rates. Doesn't seem like it could. I don't know. It just seems a little bit unfair. I understand where the lender's coming from. Now, do you see this bleeding into different neighborhoods in different rate structures? Meaning that in, let's say, a poor neighborhood or a neighborhood that may have been hurt by some of the rioting that went on is a little bit more affected than somebody that, say, is out in the burbs?
I think that really is just going to be dependent upon an individual thing. I mean, obviously, wherever there might have been rioting, there's, things that have to be rebuilt, stores and stuff that have to be restarted. And I'm sure it probably will take a nick at the value of some of the property. But I mean, lenders are only asking for us to do final drive-by appraisals, just to make sure that that particular property is still standing and that there's no damage to it.
Right.
As far as like the individuals that would benefit from it, I don't think, we're looking at any type of situation of redlining or anything, but that, whoever is going to fit those guidelines would benefit from it. So, I mean, that could be pretty much anyone, anywhere that they're located.
No, I'm glad you said that about redlining, because that's the main thing I worry about in all these situations, is that instantly areas which can least afford to have service get redlined, and therefore either the rates go up or the products disappear. And so when somebody's trying to get a home in a particular area based on whatever the lender comes up with, but if it isn't that, that's a good thing. And I think that has to be really maintained.
I think that's what we have, the HMDA for, that is, to regulate a lot of that. And then of course, when our borrowers fill out the 1003 or the application, they have the right to be able to put information on there, like they don't want to disclose their ethnicity, or, race or gender, or, any of that information. So there's some, ambiguity regarding that. And then as far as like the areas are concerned, I would go so far as to say that with a lot of the underwriters that are looking at the files, they're looking at so many different files. I don't know if I believe that they would actually take the time to say, okay, this is in this particular area, and so we don't want to, invest in that area. But as much as reviewing the appraisal report and just making sure that, it's a good property, that everything is stable, and that they're not going to be in a situation where they have, a house that's surrounded by a lot of foreclosures, and that, our borrower could end up being in the same situation. So other than that, I don't think so. And I think, even though there may be a situation where we have to have a minimum 640 credit score in a lot of cases, I would say most people are probably, or at least the people that I have experienced, are right around that, if not better.
Right.
And if they're not, then as a loan officer, it's my job to help them get to that place. So, there are certain things a lot of times when we look at the credit, we can tweak, and, I can make suggestions that will hopefully get them to a place where they'll have that 640 to be able to get it. But if they do have it and they're better, even higher than that, then they're in a situation. There might have been some people who were right on the fence who maybe had debt to income ratio issues before, but now being able to get, a 30-year fixed loan, whether it's FHA or conventional, at a 3 1/4 rate is a great opportunity, and it gives them more buying power.
Oh, I agree with that. In terms of the rates, in terms of the availability in the marketplace, great. What are you seeing in terms of the programs in general? Do you see any specific program targeting specific markets, or are these all just Fannie Freddie type loans that are being sold to?
We did have one lender that was offering some of our frontline workers a $1,500 credit at closing. So they were kind of, ending that the end of last month, but I'm sure they may come back, and offer it again at some point. But, it's sort of an incentive, whether, as far as like a purchase, anyone who's been frontline worker, and that doesn't have to be a doctor, or, a nurse. It could be, an EMT driver, firefighter, anything like that, police officer. But, it's a $1,500 credit towards their closing costs, just as a way to sort of say thank you for, all of your service.
Well, I like any kind of incentive that would help anybody is a good thing. Anybody that needs help in these times, and there's plenty of them. What do you see in terms of your own business? Where is it coming from mostly? Are you still a lot down in Florida? Are you doing in Illinois? Is it mostly here in Nevada? Where are you getting most of your clients now?
There's Florida, there's some California business, and a couple of borrowers from Illinois have reached out to me in regards to doing some purchases, and so hopefully we'll have some things going in that direction for sure.
Do you see property values maintaining and going up? I know that the numbers last month said that that was exactly what was happening, is that even though we have a very tough market, what we haven't seen is the fall in real estate prices.
I would agree with that. I know that, in the past I've had a couple of times where maybe, especially with purchases, and even with some of the new construction, when the appraisers were going out and sending back the report, we might be off by $5,000 or $10,000, and so then there was renegotiating of the sales price. But consistently, it's seeming like across the board that the values are coming right in. And even for the refinance, like if the borrower's anticipating a certain value, and they have a general idea what their home is worth when they talk to us, and and then we do our research and compare numbers. I'm finding that we're kind of coming right in, just as expected. So I'm not having any situations where we're having to really do any rebuttals of values or anything of that nature.
Hey, Jennifer, we're up against it. Shout out your phone number for people who need a terrific loan officer in many of the states that Malibu Funding works in.
My number is 773-593-6831. Or, of course, anyone can call the office for me as well, 818-719-9901.
Jennifer, thank you very much. Once again, all the answers, it's perfect. I got 100 on that test. That's great. Excellent. Thank you.
Well, thank you so much for having me, Jeff.
Thank you very much. That's Jennifer Conrad. She's a terrific loan officer for Malibu Funding, and I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. And thank you very, very much for tuning in and listening to the show. We're on 5 different radio stations, from Albuquerque to Las Vegas, from the Inland Empire in Southern California up to Tahoe. And yes, 5 times better for you. And if you're driving up the coast, you can probably hear us the whole way on Saturday or Sunday. And if you do that, well, that's great. And go up and see my sons. They're both in Portland and Seattle. There's a lot going on in the country in the lending area. And one of the reasons that I brought Wendy Van Wessel on from Stearns is so that she can tell us what has changed and what is current in the lending area and when it comes to programs and what you might be able to expect if you want a loan right now. Wendy, how are you?
I'm just fine. And you, Jeff?
I'm tired. You know, why is that? I just, maybe it's because I've got COVID fever here. I just can't get rid of, no, not the COVID fever. I mean, like sick of being around, staying at home. And I guess I'm not alone. There's many millions of people out there who are now out frolicking. How are you doing, by the way?
I'm doing just fine. Get up and move around and make sure that you get your endorphins going. I think that people sit too much on their behinds, and maybe that's why making you tired a little bit.
Yeah, that could be. That's true too. You know, I have a downstairs basement office where we broadcast the show and that I do most of my work. So it's a little dark in here. It's a little cold. So maybe that's it. Maybe you're right. I got to get outside, walk around a little bit.
There are a lot of opportunities out there. The rates are really low. I think that we're all very busy with all the refinances out there. It's a good time to do a loan. I mean, even if you wanted to do a purchase, it's just a desktop appraisal. You don't have to let the appraiser go in there, and you can do exterior only appraisals now. So there's changes for the better to accommodate us in this COVID-19 era, but there's also some caveats that have made it a little bit harder for us too.
Okay, walk us through a typical loan. Now, rates are so fantastic. Everybody out there is looking for somebody that can do the loan for them. Give us your typical borrower that walks in the door or calls on the phone and says, I need a loan. What do I got to do?
We have a lot of refis going on now. More
Yep.
than it's always be the other way around. So if you, for example, if you are 80% or under in your loan to value for a refinance, you only own one property and you're a straight W-2 or salaried borrower that is still working, then you can get really great rates. I mean, it's called, for us, it's called the Accelerator Program, but I mean, they're 2.875. They're very historically low. So there's some good programs out there to do refinances with. Now, that being said, you got to look out for verbal verification and written verification of employment. Since so many people are unemployed, they're doing it at docs, and they're also doing it the day within 24 hours of funding the loan, making sure that you're working to capacity, that the numbers that we're using to figure out the debt to income ratio are still valid today.
Okay, give me an idea of the logistics of that. It sounds like a nightmare for you all to try to get these people on the phone more than one time to verify the employment. How's that working out?
Well, it's a little bit more difficult because the phone number has to be associated with the company, and a lot of people are working from home, so they're not associated with the company as their cell phone. So then we got to go to a company email, and they're answering questions like, has COVID affected the income that so-and-so is making? They're working at half capacity and all those types of things. We've got to make sure that they have the ability to pay. And that leaks over into the rental side of things too, but I can start that one later. So it just needs to make sure from your supervisor, they won't do the 800 numbers anymore because that's not up to the month or up to the minute income. And things change so rapidly with some of the employers running out of money to keep the employees employed and not going on unemployment.
You know, it's a quagmire, right? I mean, you have these terrific rates that people should be taking advantage of. Really, I mean, if you got a house 2 years ago at 4 to 4.25%, and you can drop that and maybe get into a 15-year at the same payment, yet you're having difficulty proving your income because for whatever reason it's just not working out. It's a conundrum, and it's a shame because these rates are. I don't know if they're gonna. Every time I say this, it goes lower, but I don't know how much lower it can go. Your thoughts?
I think they're going to stay lower for quite a while.
Yeah, that's what I hear too. Yeah.
Welcome out of this COVID, this shelter in place. I think that people know to wash their hands, to put a mask on if they're in big areas, and just to be careful, not to be, locked down because our society can't handle it for too much longer. And there is that herd immunity too, where people usually build up their immune system to battle some of those viruses out there, but I'm not a doctor.
No.
And if we were talking about W-2 employees, self-employed borrowers need to have a current P&L or audited P&L, and those are expensive, and last 2 months bank statements to prove that the income is still coming in. And if they're self-employed, maybe a couple of invoices from the people that are still doing business with them to prove that they're making the money that we're qualifying them with.
Okay, now outside the box, things that you don't sell to Fannie and Freddie or Ginnie, what, do you have programs? Are you working with any borrowers who are like, that?
The non-QM, the bank statements or those other things, those are gone because there's no investors for them. But we do have a second on a purchase
Okay.
with a high balance in Los Angeles County being $765,600. With a $500,000 second, you can go to $1.265 million on a purchase only for now.
Okay.
Have our piggyback second. I also wanted to address the foreclosure, or not the foreclosure.
Forbearance.
Forbearance. Because that is something that if people don't need it, please don't do it. Just don't do it. If you don't need it, don't do it. If you do need it and you've used it for 2 or 3 months and you have the funds somewhere to be able to get current, you can do a loan, no problem. If the bank called you and said do a forbearance, there's no problem with it, and you never utilize it, you can still do a loan. If you can't pay back the payments that you skipped and you modify your loan, then we'll need 3 months worth of payments before you can do a loan again. And that has really loosened up from when it first started.
Right.
Everybody was still wary about it.
Well, nobody knew what was happening, and part of this process has been an involvement from the Fed and from the Treasury, and obviously all of the people at Freddie and Fannie trying to figure out the best way to be able to have people take advantage of these super low rates at the same time, not handcuffing themselves with debt that they can never get repaid on. Not quite sure how it's going to work out. We have about 4.5 million, let's say, borrowers in forbearance. So I don't know. How are you approaching it over at Stearns?
What I just said, if they bank
Okay.
calls them and put themselves in forbearance, but they never utilize it, they can still do a loan. They can make themselves current with their own funds. They can still do a loan. If they've modified their loan because they can't pay back what they skipped, then they have to make 3 months after it's been taken out of forbearance, and they have to do 3 months worth of timely payments, and they can do a loan again. So that's putting them back about 3 months.
So Wendy, let's say you're in forbearance, right? And you're now coming out of forbearance. You can't make yourself whole, but at the same time, you probably can get 3 months in a row so that you can refi, your job got back. You want to tack that on to the end of your loan. You have to go through a whole process to get a new loan. How does that actually work?
You don't have to get a new loan because you're working it out with your lender, and they're going to either extend your terms, like add more months on the back of it, or put it into your principal and then change your payments, but somehow they'll modify it, like a loan mod in that respect. And
Well,
that's
doesn't that hurt your credit?
I'm sorry?
When you do a loan mod, doesn't that hurt your credit? The actual term loan mod used to mean death for any kind of refinance.
And I don't know what forbearance is going to do to
Right.
these scores. I'm not sure.
Yeah, it's one thing because I know that when it's said, and I read the guidelines that came out last week about tacking it on to the end. Okay, you tack it on to the end, but what do you mean? How does that work? You signed a note at one. Don't you have to re-sign a note or do a whole new payment plan? And doesn't that come up on your credit as, a loan mod?
There's a whole list of different things that you can do, and one of them is to change your terms. So you have a loan for 360 months, and you missed 3 payments. Well, now you're going to have a loan that's divided into 363 payments because they're just going to tack it onto the end, or they're added into the principal. They have different ways of doing it, and that's when you call your lender after you've missed your payments and see how you can get out of it because you're back to work again.
I see. Oh, hey, I've just been given the high sign. We're out of time. Thank you once again for coming on. I didn't even get to my controversial stuff. Jeez, I'm sorry to hear that. Wendy, thank you very much. You want to shout out your phone number in case somebody wants to contact you directly?
Sure, 818-292-2572. I look forward to answering any questions that I can for you. And Jeff, thank you for having me.
Thank you once again. That's Wendy Van Wessel from Stearns Lending. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to the Mortgage Voice with your host, Jeff Barton.
Hi, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks very much for listening. Thanks very much for tuning in. You can see us on YouTube. If you go to YouTube, Jeff Barton, the Mortgage Voice, we're also on 8 different podcasts, the major podcasts, the Big 8 they call it. And we're also on 5 different radio stations from Albuquerque to Las Vegas, Nevada, a couple in the Inland Empire in Southern California, as well as up in Tahoe at K-Tahoe. All of these stations bring to you on Saturday and Sunday morning information about what's going on in the mortgage market, to help you decide whether you're going to buy and sell. Obviously, what we're looking at in the refi market is that rates have been just phenomenal, really low. And so as a result of that, what have we got here? 30-year fixed rate at 3%, 15-year at 2.5%, FHA at 2.5%, and the jumbo at 3.95%. All of these are really, really low. The FHA and the 15-year specifically, 2.5%, 2.56, 2.60. So it's been fluctuating, but on the downward cycle, we did see this week the bond market respond, and really the range of how bonds are trading, and that really affects, that 10-year bond is what affects the mortgage interest rate between, well, it's all less than 1 point, right? I mean, it's tremendously low, which is reflected in the mortgage interest rates. And we've seen those ranges from, let's say 0.63 to 0.83 in that short range, in that window is where the rates will range as well. So if you're on the high side, the rates may be a little bit higher than 2.5. If you're on the low side, they may be right at 2.5. But in terms of your FHA and your 15-year fixed, always love that 15-year fixed. And if you can believe it, and you had a mortgage, let's say you got a mortgage 2 years ago and it was 4.5%. If you can go down to 2.5%, you can cut that amount of time by 15 years and probably end up paying very close to what you're paying right now. Now that's phenomenal if you can get rid of that mortgage. Now the refi market is what's buoying what's happening in the real estate market. We are not seeing sales the way we'd like to see sales, but then again, we don't see building the way we'd like to see building. However, building sentiment came out this week, and there are 3 components to that building sentiment, and the builders around the country talk about how they're excited about either consumer interest, they're excited about the prospects of building in terms of the cost, and they're also gauging how long to market. All of these 3 indexes jumped within this builder index, what do they call it? The builder confidence index. Yes, thank you. It was around, well, when COVID hit, it was at about 60, 65, fell 30 points to 30 points. Now that's horrible. It's the lowest it's ever been. However, this last month, May, saw that particular index jump 25 to 30 points. So we're almost back to the confidence level, maybe 10, 15 points less than we were prior to COVID. Now, what does this mean? Now, these are forward-looking indexes. And what the builders are seeing is the pent-up demand. I mean, it is unbelievable. I talked on my LinkedIn show. I have a 1-minute mortgage minute that I do each and every day. Well, let's say 4 days a week that I do it on LinkedIn and Facebook and Twitter and Instagram, talking about why, in fact, there is discrimination in housing and why, in fact, there's discrimination in lending. One of the major aspects of any discriminatory look is the affordability. If you are a poorer person, if you are a person, a minority person who lives in an area where the rents are high and the availability of housing is low, there is just no chance that you can go out there and get a mortgage for a house because you can't afford it. Any area, pick an area in the country, and you will see that the median price of that area has risen steadily for the past 10 years. Even in this environment, those numbers have continued to rise. 3% last month in my particular area. Now, why is this? Because there's no housing. So if you have builder sentiment that says, okay, I've got confidence in the future. I know we've got demand, so therefore I know we can build. The only reason a builder builds is to make money, okay? And so if you're going to make money, that means the price of the house has to go up. So how are you going to deal with a certain level of the population who really can't sustain rents escalating, and they have no equity in their house, but they can't come up with the money for the down payment or the money for the mortgage? These are working people. These are poorer people in poorer neighborhoods. A lot of them are not as educated, let's say. Now, education is another issue. We look at that in hindsight and say, okay, if you're college educated, you're going to make X amount more than if you're high school educated. However, there are many studies that show that plumbers and carpenters and a lot of other tradespeople who are not college educated make terrific money. So I'm not quite sure whether the education benefit analysis is really that, hey, let's get everybody to college, because I think a lot of the college money that's spent out there is a total ripoff. And if you're thinking about investing in going to school or going to a trade, call me. Let's go through the analysis. I think once you get a trade, you can go back to college, because then you can be able to afford it, not get yourself into debt. These are just things that I think could happen in certain areas. However, the housing issues, municipalities, cities, counties across the country have a problem. They have a homeless problem, they have a housing shortage. And because the two are very much related, a lot of budgetary items, a lot of angst, and I guess uncontrolled frustration is what I would call it, from a general public who thinks, hey, I'm paying my taxes, why do I see this? And then people who can't get into housing, who are forced either onto the streets or into poorer neighborhoods because that's all they can afford. They're wondering, where is ours? All of these things need to be addressed, and there are some plans. I do have a couple of ideas myself. We've talked about it in the past, being able to use municipal land in a situation whereby housing can be built for a lot cheaper, deeding properties to people and deed restricting them to make sure that those properties remain at that price, as people tend to move up from certain price points once they get job and once they get housing. And housing is the key to a lot of these. If you have a house and you live in a neighborhood that you own, you're more apt to protect that house. You're more apt to keep that house up. Why? Because that's your investment, that's your home, this is where you live. And a lot different than government housing, Section 8 housing, or a lot of other things that the government has chosen to use as a way by which they can say, hey, we're doing something for low-income housing. Also, a couple other things in the news which I thought was interesting. Beyond the home prices, which keep climbing, we see 4.66 million people still in forbearance. However, that number is down. It's not down significantly, but it is down. Over the past 2 weeks, we've seen it come down about 150,000 people. Now, what this means, forbearance, right? That means I stopped paying my mortgage because the federal government said I didn't have to because of COVID. There's no litmus test for whether you qualify for that. You just tell your servicer or your lender, hey, I can't pay anymore, and you don't pay. Everybody's well aware of it who has a mortgage. 4.66 million people in forbearance. However, if you come out of forbearance and you pay for 3 months, you can tack the amount you didn't pay on the back end of your note, and you can refinance. That was new that came out last week. I think we talked about that on last week's show. That's a significant improvement for you. However, you have to be paying, and you have to be paying for 3 months. Having the ability to pay is the main element to getting any loan. It's the main element to prove that you can get a refi. So if you're out there right now and you're thinking, okay, I want to get in on these low rates, and they are historically low, and you haven't been able because you've been in forbearance. Let's say you got into forbearance in March or early part of April, May, June, that's 3 months. We've seen the rates drop by 0.5 point, maybe 3/4 of a point since then. So if you got a mortgage at 3.5% FHA, you could drop it by a full point and make some dough, meaning that you don't have to pay that dough out every month. You can keep it in your pocket. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks very much for tuning in. Hope to see you on LinkedIn, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.